Welcome to Regulatory Ramblings. Our podcast today is brought to you by the University of Hong Kong's RegTech Lab, the HKU SEF FinTech Academy, the Asia Global Institute, and the HKU edX Professional Certificate in FinTech, with support from the university's Faculty of Law. I'm your host, Ajay Shamdasani. We'll kick off today's broadcast with a discussion of our Spotlight segment with a returning guest to this program, Don Day. We'll be discussing the Hong Kong Securities Futures and Commission and the Hong Kong Monetary Authority's newly issued supplemental circular updating the framework for intermediaries' virtual asset activities in the territory. Following that, we'll chat with Philippa Allen of Hong Kong-based IQEQ about the compliance implications of large numbers of mainland Chinese high-net-worth individuals and politically exposed persons parking their funds, and all too often themselves and their families, in Singapore, especially in recent times, particularly post-pandemic. But first, in a recent LinkedIn post entitled Hong Kong Raises the Bar on Digital Finance, Donald Day praised the SFC and the HKMA's recently issued circular update on the territory's framework for intermediaries engaged in virtual asset activities in the city. Key changes include permitting licensed firms to offer staking services as well as, quote, use off-platform execution channels and facilitate subscriptions/redemptions in virtual assets, giving institutions and investors greater flexibility. At the same time, retail clients remain protected through knowledge tests, suitability checks, and strict custody standards, end quote. Don notes that such updates show, quote, how Hong Kong is balancing innovation with trust, reinforcing its role as a leading global hub for regulated digital assets and institutional adoption, end quote. He points out that Appendices A and B provide the updated licensing and compliance terms, and, quote, these refinements balance market development with safeguards, further cementing Hong Kong's role as a global hub for regulated digital assets, end quote. As for Don himself, he's the Chief Operating Officer of VDX, a fintech startup in Hong Kong, building a digital asset ecosystem for institutional investors. Previously, he was the in-house crypto expert at the SFC, Hong Kong's capital markets regulator, where he helped shape the licensing regime for virtual asset trading platforms and designed and led the supervision of virtual asset fund manager and trading platforms. Don is a veteran of Deutsche Bank and Accenture. He was a co-founder and partner and CTO at Bletchley Park Asset Management, an institutional-grade crypto hedge fund, where he led systemic portfolio management. Donald has served many roles in brokerage and hedge funds, and was CEO of Quantex, a pan-Asian OTC derivatives brokerage, Delta One trader at Singati, a multi-strategy hedge fund, and a quantitative strategist and trader at Deutsche Bank. He started his career in the capital markets practice of Accenture, where he helped design and build world-class trading systems for some of the largest equity and derivatives exchanges. He holds an MBA from London Business School and a Master of Computer Science degree from LMU University Munich. And with that, Don, thank you so much for joining us.
AJ, thank you very much for having me. It's great to be here again.
So in your recent post, I want to come back to that the HKMA and the SFC issued. You said, quote, these updates show how Hong Kong is balancing innovation with trust, reinforcing its role as a leading global hub for regulated digital assets and institutional adoption. Why are you so upbeat? Why? I mean, there was a decidedly optimistic tone, and you are optimistic by nature. But why? But you're also a computer programmer, so you also take a no nonsense approach. In that sense, binary thinking can be a good thing. Why the optimism?
So I think throughout my career in traditional finance and also digital assets, I've seen maybe both sides of regulation. It can either constrain or it can incentivize or even unlock innovation. And I think this joint circular is a good example of a further development. So first of all, I think it's very encouraging to see that we have 4 regulators in Hong Kong, but the 2 main regulators are working together again. That's not always the case. And for example, the States obviously has a problem that the regulators aren't always working together. But back to your question. So when one looks at the digital asset regulation over the past maybe 5-6 years, and it obviously follows a step-by-step, a very cautious approach, very much an approach that is designed to protect investor assets and protect investor interests. The flip side of that is that obviously digital assets, by their nature, offer a few very different activities or investment strategies or opportunities to earn different yield or be executed differently, or also coming from traditional finance, one would like or expect to see very similar avenues for trades. And I think this joint circular is another step, not the final step, but another step. So what does it allow? It allows staking. So staking basically is a fundamental part of any proof of stake blockchain. It basically means you lock up your digital assets, and in return, you hope to generate some yield through the validation. That before was simply not allowed, right? For intermediaries, that was not allowed. It's now allowed through segregated accounts, and it must be done through an SEC licensed platform. Fine. And we'll come to a few more details on contingency planning and so on and so forth. But basically now, suddenly, this is available. This is a yield enhancing mechanism that is now available. OTC trades probably 3 to 5 times volume of on-exchange platform, at least in digital assets. The same, I mean, we can run some cursors, but in traditional finance, but in digital assets, it's largely 3 to 5 times bigger, or even much bigger than that times than on traded on listed platforms. Enabling this now through licensed platforms off platform services, i.e. OTC, is a huge step. So this now means, as a licensed intermediary, you can now access the OTC execution venue of a licensed platform. Suddenly you can do block trades. Suddenly you can act much more in an institutional way. Institutions often would say, okay, get me long $10 million worth of Bitcoin. If you try that on any licensed trading platform, especially those in Hong Kong, we all know liquidity isn't phenomenal at the moment. That would be very difficult to do. Now, suddenly we can do this in a licensed, regulated manner with guardrails. It also obviously leads to at least an attempt to strive for best execution. There's also some tidying up, if you will. Subscription redemptions in kind in VA funds are now expressively not VA dealing, so that's a bit of a gray area. When you read through what you have to do in practice, it might be a little bit difficult because the involved intermediaries still need to do quite a bit, especially on the AML side and the CFT side. They still need to do a lot. So they're not absolved for that obligation, but at least it's now clarified that that in itself, just the subscription and redemption offering those services, not VA dealing. And then I think there's also some part of right-sizing investor protection. Investor protection is really important, but we shouldn't forget that institutional or qualified PIs, especially qualified corporate PIs, they usually know what they're doing. And the regulator always takes the approach that if someone qualifies as a PI, professional investor, or if someone is an institution, they maybe less formal saying they should know what they do. And this has also now been cleared up a bit, bit maturing of the asset class. So we can go into more detail of any of that if you want to, but I think in general, this is one more step of maybe 10, 15 more steps we have to take to move the regulation of these asset classes into two areas where we'd like to see it move. One is it becomes almost boringly just another asset class. And the second part is we acknowledge, or the regulator acknowledges, the specific characteristics and mechanisms that are available and brings that into the regulatory framework.
So clearly, these platforms, they're capable of doing multiple things. So there's multi-utility, and that needs to be stressed. You also mentioned that the key changes allow for greater that as a result of the changes that retail clients remain protected through knowledge tests and suitability checks and strict custody standards. Is that necessarily the case? I mean, I guess what I'm wondering is that enough? What more can be done to protect retail customers? Because all too often we fall into the quandary of equating wealth with financial sophistication. And the thinking seems to be, well, this is cutting edge, new age instruments. You know what you're doing if you venture into this space. So we're going to impute a degree of financial sophistication, which may not be appropriate. But what do you think?
It's a very difficult balance to strike. So when I was working for the SFC, you have a routine rotating role where you represent your department in a complaints meeting, and this is all the different complaints that come to the regulator. And the amount of, you would assume, sophisticated individuals, certainly very wealthy individuals, falling prey to some very obvious scams, and most of them have nothing to do with digital assets, don't even involve digital assets.
Oh yeah, this predates digital assets, but
Absolutely.
Yeah, but given that we're in a new age now, and these are so niche, these are so cutting edge, the assumption is you wouldn't have dared step into that domain if you weren't prepared.
Sure. And there's obviously the flip side to this. So initially, when the licensing framework came out for trading platforms, it allowed professional investors only. It didn't allow retail investors. And the argument was, well, this is very volatile, this is very complex, this may not be suitable for retail. But the reality of the matter is that digital assets, as of today, is a largely retail-driven market. And what that meant was retail investors were driven outside of the regulatory perimeter, and they were driven outside of the protection of the SEC licensed intermediaries, including platforms. And I think what happened last weekend is really a distinct reminder also how this market operates. So I even want to call them speculators, retail speculators. They're very happy to use large and largely unlicensed exchanges, including using huge amounts of leverage when they make money. And when suddenly things go against them, as was evident last weekend, then a lot of people immediately cry foul and require regulators to step in, even though these platforms they might have been using weren't even regulated. So let's have a look. I think in Hong Kong, we have a very strong baseline already. We have knowledge tests, we have suitability assessments, and we have inbuilt into a lot of the mechanics of trading platforms, for example, custody segregation, insurance protection, and so on. So I think retail customers, if and when they use Hong Kong licensed intermediaries, are on a global comparison basis pretty well protected. But of course, we can do more. And let's have a look at specifically the circular. So one thing that struck me was that a lot of the terms around staking may not be immediately obvious to investors. So slashing, for example, lockups, and so on. So maybe a key facts sheet or statement could be useful. Maybe a bit more plain language could be useful. Requiring incident reporting in case something happens, validator failure, for example, slashing. And this could mirror how traditional funds have to disclose counterparty or credit concentration risk, for example. So when you think about concentration limits, you don't want to concentrate everything on one validator, and then having that full disclosure could help people make an informed decision. When it comes to OTC trading, I think it would be very useful to have some best execution policies, because when you think about OTC trading in traditional finance, as a broker, you have a couple of objectives. Obviously, you want to satisfy the client at the best price possible for the client, so the client comes back and client is happy. At the same time, you yourself want to make money, and you need to find the other side. At the same time, and especially in the US, but also increasingly, of course, in Europe with MiFID and also in Asia, you need to, upon request, show that you were executing under a best execution policy. And that refers to what venue you trade on or who you trade with. What do you do if there's an outage, for example? This is a bit more relevant to digital assets than traditional finance, but I think when we transforming as many as we can of the good execution policies from traditional finance into digital assets, that would be a great step. And I think, and this was a topic on a couple of panels I recently was on, in general, when you think about everything around digital assets, around staking, yield enhancing, stable coins, and so on and so forth, there's a lot of education that needs to be done. And I think the next perimeter will be education. I think we will need to much more educate, and the regulator can play a part in that. The market can play a part of that. The market participants can play a part in that. Universities can play a part in that. We need to educate the retail investing public a lot more on specific terms, like you would if you had a structured product, like you would if you had an FX structured product, like you would if there was an optionality built in. So I think right now what we're experiencing and witnessing is a gradual expansion. I don't really like the word relaxing, because that means things were too tight before, and I don't think they were too tight. I think we see an expansion of the regulatory perimeter. I think we see more products coming in, and this will continue to be the case.
Right, they're
And
widening the frame, so to speak.
yes, well, exactly. And surely the next thing that, I mean, we already have the consultations for dealing and for custody, and we will probably quite soon see specific specialized digital asset custodians, and that will be a great step. And surely one of the next things that will come is going to be derivatives and everything that includes and entails. And again, not just copying one-to-one what we have in traditional finance, but also taking really realizing what the characteristics of this specific asset class are. So you could combine a traditional structured product maybe with a staking or yield enhancing strategy. I can't give you the answer right now, but I think there's a lot of opportunity to do that. But it seems the regulators want to take really a very conservative step-by-step approach to really make sure that they control the additional risk that is being brought in.
Which directly flows into our final question, which is, when, I think as you pointed out, that when you look at Appendices A and B, and that you think that the right balance has been struck between market development with adequate guardrails, while also giving the industry the space it needs to grow and innovate the digital assets market, and promote Hong Kong as a well-regulated global hub. I can't help but wonder, though, I mean, regarding growth and innovation, the common refrain that you and I first spoke of a few years ago when this program first began still seems to stick. Hong Kong has been a laggard. Why has progress been so slow? In earlier generations, things happened a lot more quickly, and that was, when things weren't as high tech. And the issue of, its position as a well-regulated global hub, isn't that more of a marketing issue?
I think we have topic for about 2 to 3 hours now.
Oh yeah, because it goes to the nature of the society.
Exactly. And it goes to the nature of how Hong Kong has been placing itself in the past maybe 20, 30 years and what it wants to do in the future. Look, in a short condensed version, I think Hong Kong has done a lot in the past 20, 30 years in traditional finance to maybe shed a bit of the cowboy image it might have had. It's now one of the international financial centers.
What? When you're young
mm,
and just getting rich,
mm.
you're more reckless, and once you age and become more mature and stable and wealthy, then you value stability and things being on an even keel, and you have to be mature and moderate at that point in life.
Agree with that. And I think Hong Kong previously managed quite well to set a solid regulatory perimeter framework, whatever you want to call it, and said, okay, so these are the rules, and within them, sort of like go and be successful and make money. And I think that has worked quite well. For digital assets, I mean, I remember very well to the tail end of 2018, 2019, Hong Kong was criticized a lot for being the regulatory requirements being too onerous, too complex, and a lot of people left and went to more crypto-friendly, whatever that means, jurisdictions, and then blow-ups and bankruptcies and people losing money happened there. And then those regulators suddenly saw the need to tighten up. And Hong Kong went, I think, a different, but I feel very successful approach. There have not been any blow-ups or big catastrophes in Hong Kong. It's quite solid. It's now being carefully expanded, opened up, widened. Um, there's a lot more institutional interest here because at the end of the day, what do financial markets trade in? They trade in trust. Trust is the fundamental fabric of every financial market, and that's what institutional investors want and need. And I think we're building that in Hong Kong now. I'm not entirely 100% optimistic, because it obviously also must be possible to be commercially successful under this framework. And in the past months, and maybe 12 to 18 months, there were a lot of voices in the market who said, well, it's all good and nice to have all these investor protection measures, but as a company operating in this environment, we still need to basically we need to make money, right? We need to cover our costs. We need to make money for the investors. It needs to be possible to be commercially successful under the regulation, for the regulation to, in a way, make sense, not to stifle innovation. And I think we need to probably quite quickly see a bit more of these circulars that specify, that enhance, that bring more opportunity, that enable licensed intermediaries to offer more regulated services to their clients. So the clients bring their assets back to Hong Kong. The clients interact more with the licensed intermediaries in Hong Kong, and the licensed intermediaries are unable to make money. Because if that's not the case, you're throttling a market. You're basically suffocating a market, and that can't be the answer for Hong Kong going forward.
But in the time we've got left, is there anything else you'd like to leave our audience with?
Thank you. I think there's a lot of things happening right now, and as you said, it it doesn't always. It's not sufficient to just look at regulation in a specific area in a specific geography. I think one needs to look broadly across the globe. What happens globally? Digital assets are a global asset class, so what we do here is affected by what happens in Europe, US, other parts of Asia, and vice versa. I think there are a lot of very interesting developments, especially when it comes to stable coins, especially when it comes to the whole geopolitical developments and how that affects or might affect digital assets. So I think in Hong Kong, we're in a very, very interesting place and space right now. I think if a few developments that people in the market carefully talk about come to fruition, this could be a very, very interesting place next year. But, and this is probably the cautious note, Hong Kong needs to play its cards right. And what do I mean with that? You mentioned marketing, and I personally think Hong Kong took a better approach than Singapore. Singapore had to play catch up in regulation. But what Singapore does really well is promote itself, promote Singapore in different entities of government
and
regulation.
confidently so,
Yes,
because they're
yes,
proud of their
yes,
city. Whereas Hong
yes,
Kong's such a transient place, a lot of people don't necessarily have that depth of multi-generational roots in this
yes.
town, you know.
Absolutely. And I think Hong Kong is underselling itself. I think Hong Kong has actually a lot to offer to the digital asset market, to traditional finance. Looking at this, in Hong Kong has a lot to offer in general. And I think what Hong Kong could improve on, and when I say Hong Kong, I mean Hong Kong Inc., right? I mean LegCo, regulators, immigration department, the market, all the different stakeholders, the whole value chain of traditional finance or financial markets. It would be great to see that working more in conjunction, more together, selling Hong Kong as a place that is open for business and where people can be successful.
Don, thank you so much for your time,
Definitely. Thank you, AJ, for having me again.
and we'll be right back. And we're back. We're now going to be speaking with Philippa Allen of Hong Kong-based IQEQ about the compliance implications of large numbers of mainland Chinese high net worth individuals parking their funds, and in some cases themselves, in Singapore in recent times, and in some cases outright migrating to the Lion City in the past 5 years, particularly since the pandemic. Philippa is the managing director of Regulatory Compliance Asia, a compliance veteran. She has over 30 years of extensive business and regulation experience in APAC. She founded Compliance Asia Consulting in early 2003, and Compliance Asia has been a part of IQEQ since August 2023. She was previously the head of compliance for APAC for the investment bank Dresner Kleinwort, and she was based in Hong Kong, as well as head of compliance at GT Asset Management. She was one of the drafters of the original Fund Managers Code of Conduct in Hong Kong and is involved in numerous submissions to regulators and lobbying efforts with financial industry bodies. A graduate of the University of Western Australia, having attained a Bachelor of Jurisprudence and a Bachelor of Laws degree. Upon graduation, she commenced practice as a barrister and a solicitor for Freehill, Hollingdale, and Page in Perth, in Western Australia. Philip is a frequent speaker at financial industry conferences and technical panels, and is a member of various industry representative bodies, including AIMA, SIFMA, the Hong Kong Venture Capital Association, the SFAA, and the SVCA. And with that, I will turn over to Philippa. Philippa, thank you so much for joining us.
It's a pleasure. Thank you, AJ.
So tell us, I mean, I've given your summarized bio, but tell us a little bit about yourself. Where are you from originally? Where'd you grow up? What's your background like? And how did that put you on the path you're ultimately on?
Absolutely. Well, I'm Australian, clearly. I spent most of my life in Western Australia, although my father was in the Navy, so we traveled around Australia quite a lot when I was young. I went into arts originally at the University of Western Australia, and after a very unfulfilled year, decided to switch into doing law. And
It's usually the other way around. People of a fine arts temperament go into law.
right. Well, indeed. A friend of mine has described law as the maths of the humanities. So for people to have perhaps a slightly more logical approach to the way that they like to think about things and address their work, I think law provides a great foundation, even if you don't end up practicing it. I thoroughly enjoyed it, but I was part of a move to Hong Kong. It was a decision to decide to go and live overseas, and it sort of slightly altered my course because I moved in-house, which was also a very interesting transition to be from a practitioner, based on very much on sort of hourly rates, and then moving in-house where your responsibilities are different. You have one client, essentially that company. And I was very lucky. It was in 1992 when I first started in-house in Hong Kong. And it was just at the time that the SFC in Hong Kong was starting to become a more serious regulator. And I remember distinctly that the first code of conduct was issued, and my then boss, the CEO, came to me and said, "This looks like law, you can do it," which is by default how I ended up in compliance. Ever since then, I've very much enjoyed the more practical application of compliance, the aspect of rolling up your sleeves, getting in with the business, really understanding the nitty-gritty of how they do their work, what sort of systems they're relying on, what are their processes. Because if you really understand it, that's actually when you can try and drive a good compliance outcome. So yes, it was a sort of circuitous route into compliance.
Well, the transition from law to compliance, it's a well trod path, and many have done it before you, many will continue to do it afterwards. But I mean, you could have had a very cushy life just being a head of compliance at some institution, minimum of stress as someone else's employee, but you chose the entrepreneurial route. I mean, and so you chose to build something of your own by embarking on a career in compliance consulting. How did that come about, and why did you decide to take on the extra pressure?
At that stage, I was actually living in Singapore. I had been transferred there by Allianz Dresdner, who was the then combined group of the Allianz Dresdner world. And I enjoyed the work very much, but it struck me that there was very little resource for compliance officers in the region. And I was looking at my compatriots in the US and in Europe and the UK who had access to, specialist, not lawyers, not accountants, not management consultants, but specialist compliance consultants. And we founded Compliance Asia about the same time as some of the other well-known names in the industry also founded, particularly in the US. And I'd always felt in-house to have an extra helping pair of hands, someone who really knew the topic and understood it from a practitioner's point of view would be very useful. And that sort of drove it. At the same time, I had 2 young children, later 3 young children, and I had foolishly thought that the idea of, working a little bit more on my own terms would be easier than full-time with, many, many late night conference calls, etc. That is incorrect, and I would say for anyone who's going to set up their
It
own
paid off,
business,
though. It paid off.
it did eventually. I mean, I definitely got sort of a little bit more flexibility, but it is high risk for any entrepreneur to set up their own business, and especially in a world where services industries don't get funding, and there is very little in the way of available finance for female-led businesses still in Asia. I applaud some of the banks that have set up programs, but they tend to be focused on microfinance, and there are some now private equity and VC firms who are starting to look at female-led enterprises as they start to realize that the risk profile is often a good bet for their investors.
Let's pick up on that. That when you said that it occurred to you that there wasn't that much support for compliance officers, and what is it that a compliance consultancy offers that, say, they couldn't get from a law firm or a big four accounting firm? Because in this day and age, it seems to me that a lot of different professions are offering the same things on their menu of offerings, but they may not necessarily all be equally competent at everything they're peddling. I mean, I'm sure you've seen that. I mean, uh, for example, it is not the case that even though all of the big four say that they do AML, at least in Hong Kong and Singapore, we know which ones are really strong at it because
Mhm.
we follow this space. We know which ones are strong and which ones are perhaps less so, right?
Yeah. It's a very good question. I think that, it's important for us to recognize sort of internally that some of our best business partners are actually the law firms and the accounting firms. I think they too recognize what their specialties are. You need lawyers for complex, regulatory questions. If there's enforcement action, if you have an inspection or investigation that you're starting to feel is going perhaps down a route that might lead to an enforcement action. There's also, there's cultural expectations. We find that some of our US clients are so used to dealing with the SEC that they like to put a sort of legal barrier between them and the Asian regulators, even though broadly the Asian regulators that we deal with are actually much more approachable. They're more willing to look at the industry holistically than in the US. So, there are times when perhaps over some matters we may seem to be sort of competing. I don't view it that way. What we bring to the table is a deep knowledge of the actual processes inside an asset management firm or a broker dealer. So people come to us and say, we've been told we need a policy on this. This is how we do it. These are our 20 reports we run every day, say for, I don't know, handling client monies, but they don't know how to bring it together into a workflow or a procedure that can be explained either to outside investors or to the regulator. So we're able to help them construct that. For some of our larger clients who might have a trading desk or a marketing operation or a couple of portfolio managers in Hong Kong, Singapore, Japan, etc., they don't want a full-time compliance person. They've got a big global compliance infrastructure and they don't want to overcapitalize in APAC. And so for those guys, we take on their day-to-day sort of BAU, their filings, their entries through Masnet, their entries through Wings, etc. It's not outsourcing the responsibility for compliance. It is providing aid to their heads of compliance and their CEOs and responsible officers. And that's very difficult to deliver in a sort of legal or an accounting environment.
It's incredibly easy to become jaded, though. I mean, and I know for me, towards the end of my time at Thomson Reuters, and it was a wonderful ride covering the compliance beat as a correspondent. And I guess I still do, but now more as a commentator, and I'm able to take more of a macro level view of it. And having done that with the passage of time, do you ever get the feeling that compliance is so overrated, that the things that they're asking compliance officers to do, it's in some cases it's risk management, and now they also have geopolitical risk on their plate. What are your thoughts?
Yeah, so there's an aspect of all jobs that have a sort of routineness to them. One of the great advents that I've seen over my time doing this, and something that we're investing in heavily as a group actually, is around not just reg tech. We're familiar with the concept of, onboarding via KYC systems that are online with digital, screening, etc. But more about compliance tracking, compliance monitoring, compliance report production, the nuts and bolts of it. And increasingly, there's now tools available that help with that. So they take away some of the routine work from junior compliance officers, because I would agree it's very difficult if you're 20 years ago, you're telling a young grad your life for the next 5 years is filing forms, right? It's not attractive. Now it is much more about the client management aspect of it and actually interacting, on a very regular basis with the client, talking through their problems whilst in the background, you've got the monitoring and the reporting sort of sitting in the background churning away. So I think there's been improvements overall in the delivery of compliance outcomes. Of course, all regulators can move towards a little bit of papering, which is frustrating. And in places where there's a mono regulator, you to carve out a niche that applies to your particular bit of the industry and say, we appreciate that that is an appropriate rule for banks. However, we're a broker or we're a fund manager. You need some more specialized licensing requirements and rules for us. And that's been a long journey in Asia. We're still working on it. We're still moving towards it.
Moving towards a monoregulator, well,
No,
that's
away from that idea that even
wait,
within a mono, yeah,
wait,
even within a monoregulator to say, okay, your fund managers, you need a different set of rules. There's no requirement for fund managers to hold vast amounts of liquid capital, frankly, because the risk is in the fund. It's not with the fund manager per se. So just trying to make them understand a little bit more about those sorts of things. To your point about risk, though, AJ, one of the interesting developments we are seeing now is debates within some of the biggest institutions about where compliance sits and is it actually part of the risk department. It's sort of aligned with operational risk to a large extent. So some groups are bringing risk and compliance together as a model.
I do find it is a generational thing. Here's why. There's a school of thought that says all too often they're trying to use compliance to do risk management. That risk is forward looking, whereas compliance is very much an after the fact exercise. You're trying to find out what went wrong, who is guilty of the malfeasance, you're running your investigation, and you're trying to reconstruct the story and apportion blame accordingly. There's another point of view that says no, it's all good risk management is good governance is good compliance. The tangled three threads are all interconnected, though they're not necessarily the same. But that to do good compliance, for example, if you're opening a branch in Vietnam, the first thing you do before you devise a compliance program for that locality or that jurisdiction, that particular branch, is you do a risk assessment, they would say. And based on that, you're able to put together the compliance manual and the materials. That's the more forward-looking, the more younger compliance officers seem to have that approach, and that's the view I'm partial towards. But yeah, I mean, I think they're both right in their own ways.
I agree. I think I'm partial to that view as well. And one of the other important things to consider is it's something I talk to with my own team when I'm sort of doing some mentoring, but also with clients. It is impossible to say that, if you're a large institution, but even that you can achieve 100% compliance. Compliance is a mitigating factor. You don't know if one of your employees is, going to be the next. You hope not, and you obviously put controls in place, but they could be the next big scandal. The rogue trader who goes astray, or someone who's engaging in a whole series of improper personal share deals that you don't even know about. Is that you're relying to a certain extent on the ethical and honest behavior of the individuals that work for you, which is why so much regulatory emphasis now is being placed on conduct issues and saying the organization can only go so far. At some point, people in the industry have to take responsibility for their own behaviors. And that's a much more difficult aspect of compliance to nail. How do you measure people's compliance and their attitude towards compliance? It's extremely difficult.
Oh, and certainly. I mean, I remember some years ago, someone from IOSCO was speaking at a Thomson Reuters event, and he said, "Look, in most areas of life, people know the difference between right and wrong. That they understand that murder is wrong. That they understand that you can't drive your car in reverse on Queens Road Central, mowing people down. But somehow, when it comes to financial services, all of a sudden moral relativism kicks in, and it's like, are you sure I can't screw my clients? Can you reread that passage and see if it can be construed in a way that allows me the maximum amount of latitude? I mean, it's interesting that when money's on the table, how fast and loose people can get with their morals. But I guess this ties into Singapore and the private banking sector, which is what people really want to know about. So the rapid increase in wealth management activity in Singapore, I mean, particularly with the arrival of rich mainland Chinese high net worth individuals, has meant greater regulatory scrutiny in the Lion City. And, it's meant, good business for private banking and wealth management and family offices. But against that backdrop, I guess, what are your impressions of the evolving regulatory landscape there, and the importance of compliance, and what steps firms can take to proactively adapt their strategies to navigate the heightened expectations while maintaining client trust and operational excellence?
Yeah, it's a really good point. The issue around sort of Chinese money generally is that it's relatively fluid. It can move around quite a lot. Oftentimes the wealth management activity in Singapore is not the only wealth management activity that family or high net worth individual will have. So it is difficult for institutions to attain a full understanding of exactly what they're working with. Unlike traditional European banking relationships, private banking relationships, I should say, where the family has a sort of trusted individual that knows everything, almost acts like a concierge for the entire family. What we see is it tends
It's often multi-generational in the European context.
by now, yes, yeah, absolutely. But what we're seeing now within the Chinese world, which is, as it's maybe first or second generation wealth, but also it's a little bit more segregated. So they'll sort of make an allocation decision, say, right, we will put this amount of our net worth into Singapore. They'll often still retain a certain amount in Hong Kong. There will definitely be money in Europe and the States, and so you don't necessarily have the entire picture. That makes the standard things like, KYC, and by that I mean the know your client from a suitability, product risk, total net worth, sort of aspect of what to recommend and what to invest, but also the CDD, which is the client due diligence for AML. It is a challenge. Uh, I think Singapore's recognized that, and I think the MS has done a good job in terms of keeping up to speed with the way they've needed to move. So, the changes that they recently made to make it a little bit more difficult for just anybody to set up a single family office in Singapore, I think has been a positive development because there was definitely some bad actors who exploited that. And so tightening up around that has been welcome. And it's also created a good precedent for other regulators in the region and also in the Middle East to say, right, maybe we shouldn't just let this be a free for all. Maybe we should have some structure around how we're dealing with single family offices because they're an important part of the landscape.
Well, Singapore has long had a reputation for good governance and robust compliance. I don't think the cases like 1MDB come along that often, but
No,
when they do come up, they take swift and decisive action. You can't
absolutely.
fault them for that, and that is why people often say Singapore is crushingly brutal to those that don't play by the rules.
Well, even in the most recent scandal, which I knew, has obviously had a lot of press attention, the policing was excellent. The investigation and the action taken was the Singapore police should be proud of themselves. An American police force would have, being very self-congratulatory about the whole thing and showing themselves off to the whole world over it.
Oh, completely. They would have had a huge press conference and
Absolutely.
yeah, for sure. So, I mean, look, modern compliance is a risk matrix proposition, right? So based on a culmination of multiple factors, national origin being one of them, you get a certain risk weighting, and if you're from a certain family, certain industry, certain profession, part of the country, that adds extra risk. And if you nouveau riche versus old money, that factors into the whole source of wealth, source of funds equation as well. But should we necessarily presume that just because someone's wealthy and they're from China, it's dirty money?
No.
Because that seems to be the presumption in some people's minds.
Yeah, I think that's an unfortunate generalization. I would agree. It's not the case at all. Obviously there's some extremely well-known and high-profile individuals who've made very legitimate money through very legitimate activities in mainland China, as they have in the rest of Asia. There is no predilection, I think, in any one country for it to be entirely corrupt. This gets confusing as well because obviously AML also encompasses the world of sanctions, which are effectively government penalties against bad actors, state actors. And so the two things get a little bit muddled in people's mind, making sure that the flow of money into the financial system from industry broadly or individuals broadly is money that is properly sourced is one aspect of it. And it shouldn't be confused with the sort of, well, we've got these countries on a blacklist because, they're engaged in activities that are harmful to our national interests. And so, I think that the idea of separating those two parts of AML makes sense. So your investor client facing division should be different from your sanctions checking, does this pose a threat to us? That's also nowadays increasingly tied up with cybersecurity issues, state-sponsored attacks and engagements via weak internet protocols and so on. So I think separating those two things would also help some of those presumptions.
Yeah, it's interesting because sometimes I get the impression that it's it's kind of like what we learned in law school that you'll have certain bits of certain subjects coming up in other courses, and the law really is a seamless web, and because it's so interdisciplinary, I wonder, is it necessarily worthwhile to compartmentalize to that degree? But and I mean, I guess as long as the different components can work, as long as the different elements of a team can work together
Yeah.
when needed, then I guess it's okay to separate them for administrative purposes.
I think it's also important to remember what the premise behind the foundation of the FATF was and the idea of anti-money laundering. And it was to try and reduce predicate crimes. Now, the unfortunate aspect of this is I think that gets lost. Sometimes there's so much emphasis on the process for or the procedure for, AML, KYC, identifying documents, identifying people, triple certification of things, etc., that you've got to look at going back to the, original purpose of, are we stopping some of the underlying crimes? And there's a strand in the sort of regulatory think tanks of the world saying, well, maybe we're going about this the wrong way. We're placing all of the burden on the financial industry. And would there be a better outcome if we actually diverted some of this money and attention to better quality policing in places where we know that's where the problem is emerging from? And that's a very valid point for more philosophically minded people to be thinking about.
Yeah. When it comes to China, when Chinese high net worth individuals, often, or at the very least not infrequently, they have ties to the government. So should they be presumed to be politically exposed persons, and what risks does it entail to have a client who is a PEP?
Yes, it's interesting. I think the discussion around PEPs has become very fraught lately. And one of the important things to note about PEPs is that they are not, no piece of legislation says you cannot deal with a PEP. What it says is you need to screen people and then figure out if they are, and then make your own call as the risk they pose. So if they are, a minor functionary on a, city council equivalent somewhere or related to someone who's a minor functionary on a city council, do they really sway decision making? Yes or no? Obviously, if they're part of a, a national level Congress or a national level operative unit, I would be concerned because maybe they are in a position to sway decision making. So I think that's the bit that's missing inside institutions because of the pain of trying to actually understand each jurisdiction and then figure out what the risks are of the different type of pets in each jurisdiction. People are just defaulting to everyone's a pet and we don't want to deal with them. So you have to have a much more nuanced conversation than that. It's the, at what point is a family member, is the grandchild of a pet considered to be a pet? Some institutions do say so. They say, yes, we're going to put all these connected people on the list. That gets to the point where, the compliance and AML team are actually perhaps wagging the tail a little bit or wagging the dog rather than the other way around. And yes, the commercial people and the banking people and relationship managers get incredibly frustrated. So I think there needs to be a little more nuance applied to it, and just to bear in mind that simply the appearance of somebody on the list doesn't mean that they are a high risk individual.
There's also the issue of duration that you may the person you may have been connected to, affiliated with, may no longer be relevant. They
Right,
may have been
exactly.
significant in public life at one point, but over time that they stepped aside, they retire, they're no longer in the public view. They still have political clout to some extent in terms of in the lobbying sense, perhaps, but again, that's extremely difficult to gauge. And the quick question is someone who's no longer been in office for over a decade, should they still be considered a PEP?
Right, I would agree. It can be hard to work out in some jurisdictions. There's certainly countries in parts of the emerging market world where that person may well indeed still have significant influence. If you think about, situations where a member of government has retired, but everybody knows that their nephew or their best friend's son is the person who's sort of taken up the reins. I think the problem is resourcing. How do you, as an institution, have sufficient resource to go in each of those cases and make an individualized decision? And that can be very, very difficult to do. You've got to look at the value of the project, the value of the potential fees that you're going to get out of it, your commitment and your exposure. A lot more work goes on into diligence in those sorts of scenarios, say in infrastructure funding. So, infrastructure asset management or large long-term closed-ended kind of fund projects, because if you've taken somebody in at the beginning, it then becomes very difficult. And the recent example of people having to side pocket Russian investors, even if they were never sanctioned Russians, but because of the sanctions imposed on effectively all Russians, has created a precedent for people to be concerned about that. So I do understand that some of it's a resourcing issue, and a lot of the burden is placed on compliance teams in our part of the world because of the number of emerging markets that are investable, unlike some other countries, and also that are, generating great returns. So people are interested in getting exposure.
My sense is that what I've seen in Singapore, what I've seen in Dubai and Abu Dhabi and Doha is that, yes, they want to be regarded as respectable by the international community, but irrespective of what the FATF would ideally have them do, they are in instances willing to go against those precepts, because if they know that if they adopted a zero tolerance approach, and we often hear that at events, but they know that if they adopted a zero tolerance approach, that would mean no business.
And it also needs to be, there's an element to it needing to be weighted to the level of risk as well. So, and junior compliance officers, they're relatively inexperienced. If they are left to their own devices and given a set of rules, the default position is they'll follow these rules because that's clear. It takes you some time, but also takes very good leadership within a compliance division, or it takes some good mentoring to get younger compliance officers to the point where they're willing to say, actually, I agree in this instance, maybe we don't need, a notarized document for this person, because sometimes part of the frustration that you're seeing with bankers is actually around the minutiae. It's around the insistent that, a public record, despite it being publicly available, on a company secretarial, whatever the register is, ACRA or equivalent in Singapore, that, nevertheless, you've got compliance officers saying, well, that doesn't matter. We still need to have this sort of notarized by someone at great cost to the client. So I think that that's also some of the disconnect. We really need to look at how the systems are being implemented within organizations. And some of the better run companies have definitely smoothed that process out.
Let's turn to the UK Financial Conduct Authority, and they've been spreading their wings internationally. They've recently opened an Asia Pacific office in Australia. What are your impressions? What do they seek to achieve? I mean, they don't have the extraterritorial enforcement resources of the Americans. So what I mean is it more of a representative office to let people know we're here, or does it have teeth? Do they seek to actively enforce the UK's regulatory remit overseas?
It's an interesting one. I was surprised. I was a little surprised that Australia was also the location. To be honest, there would be far more dual registered, if you like, or people, operations in Hong Kong and Singapore that have
That would have
a
made a lot more
U
sense. Mike.
yeah, a UK parent. Is a very common structure, even in global organizations, to put your Asian subsidiaries under your FCA regulated entity. So, that was an interesting decision to base themselves in Australia. Maybe the, close ties between, the ANZUS countries, etc., is part of that. But in terms of what it is supposed to be a office to understand more and ensure better quality coordination between different regulatory agencies. So certainly they do not have direct enforcement power. They can't come into, an FCA registrant or subsidiary of an FCA registrant in Asia and say, show us your books. I think, however, they are trying to perhaps understand more from an FCA point of view about what risks this arrangement that's now been in place for many, many years, where everyone's putting their subsidiaries under the UK company. They've got some strict rules on double hatting of employees. They've got strict rules of perimeter rules that it can be easy if you have too many employees who are doing double hatting to trip a local subsidiary into potentially needing FCA regulation. So I think it's partly information gathering and partly information sharing, as opposed to direct enforcement or engagement with the local entities.
So in any case, they'd be dependent on other regional regulators to cooperate at their discretion.
Right, exactly. The same, under the extensive MOUs that have been put into place. And there are that MOU network obviously is increasing exponentially. I mean, the SFC in particular has been very engaged in MOU signing. So there is a great deal of activity in that as more and more firms start to regionalize, and the region is growing a little bit. What traditionally we've all called APAC. I'm certainly seeing more cases now where my clients are also now responsible for the Middle East, or India, which, despite often being incorporated into APAC, doesn't sit on the Pacific. Australia. So, they're the remit of compliance people, heads of compliance and so on in APAC is growing. And so with that, I think it's in development that is interesting that the regulators are obviously seeing it and thinking, hang on, we better make sure that we know what's going on in all these other areas that border us.
That's interesting that I've seen that too. That Hong Kong lawyers actually very interested in India, and it's a problematic market, but
Yes.
apparently, I mean, clearly the gains must be there, right? I mean, otherwise, effort to reward ratio has to, be rewarding. Otherwise, people wouldn't bother. But yeah, it's
Oh, yes. I mean, we're
they've
seeing a
got
lot of our clients.
they've got every law in the books, but no one wants to go to court because it they the judiciary is often at a standstill with matters dragging on for years. But I'm sorry, I interrupted.
No, no, not at all. I was saying, yes, we're seeing a lot of our clients actually take the decision to go onshore. There was a route a while ago for fund managers to get sort of offshore recognition and so on. But a lot of them and took the opportunity at that point to go onshore. But that trend has continued. And it is a bit of a morass because when people arrive in India, they realize how highly regulated it is, not just at a national level, but also sort of provincial, state levels. I would agree that people tend not to go to court, but certainly the rewards are there, particularly with certain strategies. The private equity, private credit type strategies, I think, can find the access a little easier. It is more problematic for the liquid hedge strategies because, there are multiple rules and SEBI, by way of sort of minutiae, have been recently on a bit of a roadshow in Hong Kong and Singapore where they recognized that they had to do some work to re-establish their reputation with the Asian-based fund managers who were increasingly expressing great discontent with the way SEBI was restricting their ability to invest into the Indian markets. So I think there's outreach there as well.
Well, that and that there was a feeling of regulatory overreach, that the regulator was being too active, was being too aggressive. I remember hearing that when I was there this past January. But the other thing I wanted to ask you about was that it's not uncommon for people to say maintain their residences in Mumbai and basically maintain their businesses in India, and Dubai is just a short jaunt away. And I mean, and that it would seem to me that Dubai Mumbai nexus is just replete with all kinds of risks and compliance issues in and of itself.
Right, and that is the main concern, I think, for a long time that
That if you've made money in India, why wouldn't you want to live in the Manhattan of the Middle East, which is not that far away?
well, exactly. I mean, I think that there is a fear in India, a legitimate fear that that is exactly what is happening. People are claiming to be NRIs aren't, and which is why they tried to get behind, who are the investors in these funds? Are these, sort of fund of ones or tightly controlled funds that are then kind of just investing with all the tax advantages back into India and not paying their fair share of tax? But that's not necessarily the best premise to regulate everybody on. It would be highly unusual for, a huge international multi-manager, for example, to be so, have a fund that is so dominated by NRIs that it would trigger the threshold. So they need, again, perhaps to be a little bit more um, knowledgeable about their approach to the different type of product that's being discussed.
Yeah, that would be one situation where it would make sense to see greater collaboration between the regulators. That there's longstanding business ties going back to the colonial age. But in fact, I think at one time they even used the Indian currency in the UAE. But yeah, that's an instance where it would make sense for the regulators to work more closely. Uh, Philip, in the time we've got left, is there anything you feel we didn't cover? Anything you'd like to say to our listeners before we wrap up?
It's been a fascinating conversation today, AJ. I very much enjoyed it. I think that the
Likewise.
world of compliance continues to be an evolving one. To anybody who's thinking about, either entering it or, a mid-career kind of transition, I think it's really important to acknowledge and recognize that the industry needs a lot of different skill sets. Some of the best compliance people I've had have been people who've come out of, other parts of the financial industry, including a couple of people who are traders. So, they'll poacher turned gamekeeper. And it still remains interesting. It's going to be a growing and developing area. I'm still fascinated to continue to see where various aspects of this develop. And I'm very interested in some of the regulatory technology tools that are out there at the moment, which are well beyond the standard, the old-fashioned investment monitoring and restriction checking systems, but much more around the behavioral finance aspect of what we were discussing earlier, where people are trying to see if they can somehow measure behavioral patterns to figure out compliance objectives and outcomes and heat maps and so on. So yes, there's a lot more. We can come back and talk about it again endlessly, AJ.
Yeah, I'd love to have that discussion. I mean, I know fintech, regtech, subtech. We've had people do doctoral dissertations on any one of those here at HKU Law. So there's no shortage of fodder for discussion. Philippa, thank you so much for your time.
Absolute pleasure. It was very enjoyable. Thank you.
And to our listeners, thank you. Until next time.